Hello, and welcome to the SAF Magazine podcast. I'm your host, Anna Simet. As we are gearing up for our first ever North American SAF Conference and Expo in Minneapolis at the end of this month, we have and are continuing to bring some of our expert presenters onto the podcast to talk about the many crucial aspects that we will be covering at the event. Last week, we had with us Neil Jekyll of FluidQuip chatting about ethanol as a SAF feedstock. And today, we have with us Mark Riedy of Kilpatrick Townsend and Stockton to chat with us about SAF project financing. Mark, welcome to the podcast.
Thank you. I appreciate the opportunity to address your audience. Thank you to SAF Magazine and to BDI International. Glad to be here with you.
We're so glad to have you on today. So why don't we start by having you tell our listeners a little bit about your background and what you focus on at your firm.
Sure. So I'm a 45-year international project finance lawyer in energy, chemicals, and infrastructure of all types. Over my career, I've worked in almost 75 countries and lived out in Asia for over 8 years, working on some of the largest projects in the world in those areas. And I represent on the SAF side, across the board, I do quite a bit in all the renewable energy areas. But as we're addressing SAF, I would say that we represent close to 75% of the international SAF developers to date. I've been involved in 5 of the 6 project closings. That's all there's been worldwide.
Wow.
And so there's not a lot, but the market is very, very significant. To give you an idea there's right now, the latest figures I've seen is in 2022, there were 80 million gallons a year of SAF that were produced. So it's not a lot. When you think of probably 100 billion gallons of jet fuel used worldwide and projected post-COVID to be somewhere under 30 billion plus. So there's a lot of room to move there. There's a lot of targets out there. There's DOE's got their SAF target of 3 billion gallons by 2030, 35 billion gallons by 2050, which they say would result in approximately 400 SAF refineries at about 100 million gallons each. But that's for the U.S. airspace. And then if you look, there was a report back in December of 2020 by the International Commercial Aviation Organization, ICAO, where they said, I believe it was 170 SAF refineries per year would be needed each year for the next 30 years. That's just an amazing amount. And then I saw an article yesterday talking about United's work in this area, where it was stated that IATA, the International Air Transportation Association, is stating the need of 7,000 SAF refineries by the year 2050. So you can see the sky's the limit on what's going on here. Myself, I'll talk about how to finance these things, but over at the Department of Energy, I've got 5 SAF projects in there, and I've got 2 in underwriting. And of my 4 projects in underwriting across the board in lots of different areas, I've got 26 applications in over there for clients. And I've got one over at USDA in the 9003 program, which is another program that we could work in for a SAF project, smaller one. And all of those should be closing over the course of the next, say, 4th quarter into the 2nd quarter of next year. The other thing I would say is, right now there's 8 current ASTM SAF pathways, and I represent multiple clients in each of the pathways. So I think we've got it pretty well covered. And I head up a team at Kilpatrick of 38 attorneys in our energy practice group. And it deals with not just energy, but chemicals and infrastructure also.
Well, that sure is an impressive resume, Mark. Why don't you talk a little bit about programs that are available right now to finance projects?
Yeah, and to lead into that, again, I just saw an article that put it in perspective of I said the target is 3 billion gallons by 2030 on the U.S. target only. And I told you what the ICAO number would be per year for the next 30 years. But there's a group called Market Digits that produced a report very recent in the last few weeks that said the SAF industry value is expected to be $13 trillion by 2030,
Wow.
which is up from $219 million in 2022. So that really puts it in perspective. Mm-hmm. So there's different ways to finance these projects. And as I mentioned before, where I've got these projects, Department of Energy has in their Title 17 program, they have the ability to finance the senior debt, and they can do it in different ways. They use the Federal Finance Bank for the loan, and they put a loan guarantee over it. They've made some changes there under a new interim final rule where they can actually do direct loans without the guarantee on top of it. Another thing I structure over there that we're working with one of the clients on is what's called a bifurcated loan, which in this case, we're using tax-exempt bonds alongside the Federal Finance Bank loan. The guarantee, which we do have for this project, because you can still use the guarantee, is over the Federal Finance Bank. It won't go over the tax-exempt bonds, but we have then the collateral is first lien pari passu between all the lenders, the bondholders, the DOE, and the Federal Finance Bank and Treasury. So that was a big structuring effort that I started with them about 2 years ago at DOE, and that enables now where DOE could actually just do a slice of the project debt. So there's a lot of creativity over in that DOE loan program. Also, they've got a new program that came in under the Inflation Reduction Act called the 1706 program. The ones I was just talking about are the 1703 program. Those deal with renewables, clean fossil, and nuclear. The 1706 program is a different program, still within the Loan Program Office, where you can convert existing fossil infrastructure into clean energy structures. So an example there would be taking a petroleum refinery and changing the petroleum-based products from petroleum jet and petroleum diesel, petroleum gasoline to sustainable aviation fuel, renewable diesel, and green gasoline. So that's available there, and that program's got up to $250 billion available in it. So the DOE loan guarantee program in total, and they've got 6 different programs in there, have $400 billion. So there's lots of money. You're not limited by what you can ask for. It's only that the money's got to be available. Right now, there's 157 applications in for $139.6 billion. So they're not all going to make it to the finish line, but it shows you how active that program is. Mm-hmm. Aside from that, you've got the 9003 program at USDA, and that's better for smaller projects. So the ones I take into DOE would be things like woody biomass, where you're using Fischer-Tropsch to convert them over, or MSW and using Fischer-Tropsch after a gasification process to convert it to liquid jet fuel. But since you only have $250 million as the limit for senior debt in a 9003 program at DOE, at USDA, that's where I'll take in HEFA projects. So the HEFA projects, we're using fats, oils, and greases. There, you're talking about projects that might be $500 to $600 million total project cost. And you can use a number of things over there to supplement the $250 million limit. You could use equity, you could use subdebt, you could use tax equity, all kinds of different things. And so that's another program that's available. And then on top of that, we'll work with tax-exempt bonds and taxable bonds to do these projects. And the taxable bonds, you're working under state allocations. And generally, your feedstock, if it's the waste to energy, would be 65% solid at ambient temperature, which is 68 degrees Fahrenheit. So if you can meet, number one, that it's a feedstock under the Treasury definition, and number two, that you meet that 65% at 68 degrees Fahrenheit, then you go and try to get an allocation from the state, and you use that to build your projects. Now, there's different states that have large allocations, and others, the majority of states, don't have large allocations. So you've got to be selective where you're going to put your projects in. But that's where you could use somebody like a DOE to top off a project to get more debt in there to get these bigger projects done, because the ones we're working with over at US DOE are anywhere from $1 billion to $9 billion in total project costs. So they're not insignificant at all. And then the last area that is showing some opportunity is, of all places, the Export-Import Bank. Historically, the Export-Import Bank is to do projects in other countries, and particularly in, well, you can do developed and developing countries. But a number of years ago, they would allow you to do a project in the U.S. They could finance it if it was close to 90% of the product would go offshore. Now they have a new program this year called Make in America, where if you export as little as 25%, or you're competing against China, and then you only need 15%, you can get that financed if that's how much is going offshore. So that funding would be a treasury rate plus about 100 basis points, and then a small risk premium, which, since it would be in the United States, the risk would be probably pretty close to zero. Over at DOE, you're going to probably be in a range of 5 to 6%. And at USDA, in their program, your interest rate will be anywhere from 7 to 9%. At USDA, it can go out 20 years. At DOE, it can go out 30 years. At the Ex-Im Bank, you can do 18 years. But I believe under this new Make in America program, they're allowing it to go out maybe as long as 25 years. And in any of those cases, it can be a fixed rate. And DOE, you can do a 70-30 debt equity ratio, USDA 80-20, and the Export-Import Bank, there is where they normally would do up to 85% of U.S. content. There's no content requirement if you're building it in the United States. So it's a negotiable process on what your debt equity ratio will be. So those are really the ways you're going to get these large projects funded.
Okay. Thank you, Mark, for that very thorough answer. So let's move to the IRA. It was passed over a year ago. Can you talk a little bit about the benefits that came through in the IRA to incentivize SAF production and sales?
Yes. So we tried to get, and when I say we, I had put together a group called the Alternative Fuels and Chemicals Coalition, AFCC. I co-founded that. I'm the general counsel. And we had tried to get a ITC, an investment tax credit, that would have helped build the projects. And we were trying to get it at 30%. We weren't able to get that, but we did get a PTC, and we worked on that with lots of different groups. And we got a BTC, a blender tax credit. So the blender tax credit is $1.25 a gallon to $1.75 a gallon, as long as you can show you're at 50% greenhouse gas emissions reduction. You get 125. For every percentage above 50%, you get another penny, and that's how you can get up to $1.75. So the blender tax credit was put in place because it wouldn't allow for foreign product to come in along with U.S. production. The foreign product could blend it in the United States and get the credit. The U.S. producer would have to blend it some way, or they would give it to a refinery to blend or a terminal, and they would build the credit into the price, and the actual credit would be provided to the blender. So that's in place between January 1, 2023 and December 31st, 2024. So then at that point, it becomes very interesting. At that point, it becomes what's called a clean fuel production credit, and that is a PTC. So that's when you're selling it. You have it available to you for 3 years from 1/1/25 through 12/31/27. And as a result of that, the only way to get that is you've got to be able to show you're at net zero on greenhouse gas emissions at 1/1/25. And so if you're able to show that, then you can get, instead of starting at $1.25, you start at $1.75. And what one of my partners and I, for a client, got into place through the Senate Finance Committee into the IRA is a formula, which a lot of people don't know about. And that formula enables you to get a much higher price. So if you can show that you're at a negative 2.5 kilograms CO2 equivalent, you can use the formula. And the formula then, the more negative you are on your CI score, the higher the value of the credit will be. So we have clients that are anywhere up to 350, negative 350, and they're modeling, instead of $1.75, $14.50 a gallon, an enormous amount of money. And so that's in place through the statute for the next 3 years. And then it comes down to what happens after that. Will it be extended? That's something that would have to be worked on. And will it be extended with the formula or without the formula? That's would be up in the air, and those would be subject to negotiations with Congress. The other thing that you're seeing a lot of people doing are taking hydrogen and capturing carbon. So we have a client that's using hydrogen and capturing carbon, and they blend it and process it into carbon monoxide and drop it into their gas stream. And you can drop out other things into your gas stream, like renewable natural gas from dairy waste at a real low CI score to get your CI score down much lower. That can all increase the amount of gallons coming out the back end versus what gallons would come out if you didn't do that. So it gets kind of complex, but at the end of 2027, what people are doing, they're either going to take the hydrogen credit at $3 a kilogram, or the carbon capture and sequestration or carbon capture and use credits, which are anywhere for use at $60 a ton offset, or up to $85 ton offset if you sequester it in the ground. So you could take hydrogen for 10 years, it's available, so you could go out to 2038, and then you have available to you also, but you can't use them, you can't go for the credits together, but separately you could. So at 2038, you could take the last 2 years of a 12-year available Section 45Q credit, which is for carbon capture and either use or sequestration, and go out to 2040. The hydrogen credit is called Section 45V, and the blender tax credit I talked about is under Section 40 in the Internal Revenue Code. And the clean fuels production credit that comes after the blender tax credit is called the 45Z credit under the IRA. There's lots of other things you could do. If you were going to bring in the renewable natural gas, then you could avail yourself of a tax credit that's 30% for biogas, as long as you can show 52% methane, and that can be increased by 10% for domestic content, and another 10% if you satisfy the energy community requirements. So you could get up as high as 50%. And in these situations, you could either do a tax equity play or you could sell the credits through what's called a new transfer mechanism, which is a less costly way to do it. You get your money after COD, and there's no ownership tail on it like there is in a tax equity structure. So those get pretty complicated, but those are some of the many credits, tax incentives that are available that could be structured into an SAF deal if you do it properly.
Thanks for that great overview. So the final question I have for you, Mark, is what are the most important considerations in structuring a SAF offtake agreement?
Yeah, so you want to try to match up the term of your offtake agreement to the tenor or term of your debt. It's hard to get these long-term contracts. And we've been able to get on feedstock anywhere from 10 to 15 to 20. And historically, had been getting like 10 years on the offtake agreements, along with renewal terms. But we're now starting to get offtake agreements up to 20 years. And they could have renewals in them. There could be, and that's all negotiable. There could be like 1 5-year, 1 3-year, 2 3 years, 2 5 years, or some kind of a continuing 1 year after another, as long as one or the other party doesn't say they're not going to renew it any further. And you generally have a period of time in writing, anywhere from 90 to 180 days plus, to provide that written document to the other side to get their consent to extend the contract or to end the contract. So then the thing you want to try to do, we try to do as much as possible, is to get a fixed floor in the offtake agreement and as much as possible to cover the debt service. Because the last thing you want to do is miss a debt service payment and trip a loan covenant and be in default and can't cure it. But what we're doing now in some contracts, which are very interesting and we haven't seen them done, is getting not only the debt service covered, but returns to the equity holders and O&M costs. That can be tricky. So, and that makes for a fairly good size floor in terms of dollars per gallon. And so that's something that we're structuring. Once you do that, as part of that, you're going to, as part of that price, part of the floor, and then above the floor, we'll do a sharing arrangement. The sharing arrangements could be all over the place. They could be 50-50 to 80-20. I am representing mainly the developers, so I'm certainly going to try to get the largest percentage in favor of my clients. So you've got that on top of the floor. Within the floor price and the sharing arrangement on top of it, you're on your pricing provision, you're doing a rack price of petroleum jet, and that can be measured off of OPIS or Argus or Platts. Those are the providers that you can price from. And then on top of that, you're adding your RINs, you're adding your LCFS, and you're adding the tax incentives. So it can get to be a pretty strong price. And then depending on who you're dealing with, if you're dealing some airlines, they just want you to provide them an equivalent SAF price to the petroleum price that they would be paying. And they don't want to deal with the regulatory incentives, the RINs and the LCFS, or any of the CORSIA. They want to, or the tax incentives, they want you to do that. So you'd have to, oftentimes we'll use a trading company to monetize those incentives. But more and more we're seeing airlines now coming on board to do what I was suggesting, the entire slate of the rack price, the RINs, the LCFS, the tax incentives, and doing the floor price and the sharing arrangement, and including in that all kinds of different things. So that's kind of the way we put those offtakes together. And then you got to be, right now for these tax incentives on SAF, the IRA is requiring Corsia for life cycle. And for other products, GREET could be DOE argon, GREET, or CARB, California Air Resources Board, GREET, for that analysis. And there's a big fight going on right now to try to get Treasury to provide optionality on SAF. So it's not just Corsia, that it could be GREET, or at a minimum, a combination of being able to pick whether you do Corsia or GREET, either argon or CARB. But it becomes, important when you're going overseas, because there, the European Union through ICAO is going to require a Corsia model. And one of the concerns about Corsia, and why people are having trouble if that's the case also in the US for SAF, is that it is really anti-row crops. So corn to ethanol as a feedstock, corn oil, soybeans, canola, but the waste fuels use cooking oil or things like camelina or periwinkle or jatropha oil. Those are waste oils. Those could be used. But that has a big effect on our farmers in the U.S. who would like to see a GREET model. So that's another thing going on right now in a battle between Treasury, DOE, and EPA. That's something you got to consider too. And then lastly, I guess, in addition to the long-term contracts, whether it is a offtake agreement or a feedstock agreement, you want to have a very strong party that you're dealing with. You want to, as much as possible, have a credit-rated party, if not somebody that is very close to it. And that can be tricky. So those are the kind of things I'm looking for at a high level when I'm negotiating these types of contracts. And to date, I did the first two SAF agreements over 10 years ago now. And I've done somewhere close to 26 to 27 of them to date on just the SAF agreements. And I just completed the end of last year the first power to liquids SAF agreement using hydrogen and carbon capture, CO2, and blending, processing it into carbon monoxide, and then using a Fischer-Tropsch unit to produce jet fuel.
Okay. Well, Mark, I think we better wrap it up. I just want to say it's been a pleasure as always. I really look forward to seeing you and watching your presentation in Minneapolis in a few weeks.
Well, thank you very much. I appreciate the opportunity to speak again to your audience, and I look forward to seeing you out in Minneapolis at the end of the month.
Absolutely. And to our listeners, Mark is presenting on panel Perfecting the Interplay of Policy, Incentives, and Financing to Increase the Chances of Project Success. That is at 2:40 p.m. on August 30th. To learn more about the event or register, go to safmagazine.com under the Events tab. I hope to see you there. Thanks for tuning into this podcast. Until next time.